Okay, let's get right into it. The markets are on red alert. If you're looking at the futures market right now, you know exactly what I'm talking about. So here's what you need to know to survive the Monday open. First things first, the market is flashing some seriously bright red warning signs. There's a huge wave of selling pressure building up, and we need to break down the hard data to see exactly what is going on. You know, to really get what's happening, you have to look back at Friday's close, which was basically a preview of the panic. It was a real bloodbath. The Dow, it just plunged over 521 points. The S&P took a big hit, and not even the high-flying Nasdaq could get away from the sell-off. This really set the stage for a super tense weekend. And then, just when you thought it couldn't get any worse, boom. After the bell, the floor completely fell out. Dow futures just cratered another 622 points. I mean, the speed of this drop is just staggering. This isn't some slow motion thing. This is a geopolitical shockwave tearing right through the market. And here's the why. This is the catalyst. Over the weekend, this direct military engagement, Operation Epic Fury, was launched. This is exactly the kind of black swan event that sends markets into a total tailspin. You know, investors hate uncertainty, and this operation just pumped a massive dose of it right into the global system. So, this all boils down to the single most important question for every single investor right now. Is this just a temporary geopolitical shock that the market is going to digest and forget about in a few weeks? Or is this the very beginning of a structural energy crisis that completely changes the game? Now, the shockwaves from this are already spreading across the globe. And honestly, one of the most vulnerable major economies out there is India. So our first big warning sign comes from the GIFT Nifty. You got to think of it like an early warning system for the Indian market. It trades for almost 21 hours a day, so it catches the instant global reaction to news like this. And right now, it's signaling a major storm is coming for the open, down 184 points. And this chart, wow, this chart just perfectly illustrates India's biggest vulnerability. A staggering 88% of its crude oil is imported. This massive reliance basically makes India's whole economy a hostage to global energy prices. Any disruption to the supply chain could have a devastating impact. And that dependency gets even scarier when you look at a map. Half of all that imported oil has to squeeze through the Strait of Hormuz, a tiny waterway that has now become the absolute epicenter of this whole crisis, especially with Iran claiming they've shut it down. Okay, for all you traders watching, listen up. These numbers right here are the battle lines. 25,100, that's the first line of defense. If that level breaks, we could see a massive wave of selling, pushing us all the way down to that next major defensive zone. So with all this fear, all this selling, you have to be asking yourself, where is the smart money going? Because in every crisis, there's an opportunity, and capital is already on the move, rotating into new sectors. Well, the obvious place is aerospace and defense. But look, this isn't just some knee-jerk reaction. The defense sector has been a safe bet for investors all year. This conflict, it's like pouring gasoline on an already roaring fire. These stocks were climbing way before this weekend. This quote just nails it. It perfectly captures the huge shift in thinking here. For months, this has been a readiness play, building up weapons for a potential conflict. Well, now it's an active consumption play. They are supplying a live conflict and are going to have to replace every single missile that gets fired, and fast. And let's be crystal clear, these are not short-term trades. We're not talking about small contracts. Just look at these numbers. Lockheed has a backlog of almost 200 times $1 billion. RTX is sitting on over $250 billion in orders. This conflict is only going to make those gigantic backlogs even bigger. But, in the 21st century, wars are fought on two fronts, the physical one and the digital one. And the digital front is where things could get really, really messy. All the top military analysts are saying the same thing. Iran's most effective counterattack is probably going to be through asymmetric cyber warfare, hitting critical infrastructure. And that instantly transforms companies like CrowdStrike from just being tech firms into essential national security utilities. So, when this kind of panic hits the market, where do investors run to hide? Well, there's a classic playbook for this. It's called the flight to quality, and we are watching it play out right now in real time. And of course, gold is doing exactly what gold does. It's surging past $5,296 an ounce, and it just put up an 11% gain for February alone. I mean, during times of war and global chaos,
Investors have run to gold for thousands of years. It is the oldest, most trusted safe haven asset on Earth.
And this right here brilliantly illustrates the great debate that's happening right now. While gold is soaring, Bitcoin is completely failing the safe haven test. It's selling off hard, trading almost in perfect lockstep with high-risk tech stocks. So for now, the market's verdict is in. It's a risk-on, speculative asset, not a geopolitical hedge. But hey, if you're looking for a place to hide out inside the stock market itself, you have to look for shock absorbers. Think consumer staples, companies like Procter & Gamble, and value retailers like Walmart. They sell things people need no matter what's happening in the world, which gives them a ton of stability when the rest of the market is bleeding. So with all this chaos and all this uncertainty, is it finally time to hit the panic button? Well, not so fast. Let's zoom way out and see what history can teach us about surviving moments exactly like this one. Whether it was the Gulf War, 9/11, or the COVID crash, history shows us that markets are incredibly resilient. The initial shock can be absolutely gut-wrenching, creating these huge drawdowns you see here. But in the long run, the market has always found a way to come back. And the data, it really speaks for itself. The recovery from the COVID crash, a 37% drop, was measured in months, not years. The real difference is whether the shock triggers a deeper structural crisis that actually breaks the financial system, which is what we saw back in '08. That's the real risk here. So history gives us the map, but it doesn't guarantee the destination. And as we head into an incredibly uncertain week, the question that every single investor has to ask themselves is this: is this time different? Does the risk of a full-blown energy crisis from a closed Strait of Hormuz finally change the rules of the game?